Rothschild, Chapter 23 of Security Analysis. Nothing I say is investment advice, and I'm here to open a discussion about the book, not replace the contents. So diving right into this chapter, this is about the technical characteristics of privileged senior securities. So basically all of the rules that can go along with owning corporate bonds. A lot of times, before reading this book, I didn't realize how many things were involved with corporate bonds. I thought they were much more like straight investment, much more like, they are what they are and that's it. But corporations can have their own rules, their own way of the way their structure works, and you have to read through their documents to get a good idea. But specifically with this part of it, we're going into mostly we get into the different types of privileges that bonds can have. So these types of features that he's talking about are ones that are generally things that enhance the bond. They try to attract buyers by saying, oh, well, you can, change it in for stocks, for example. That's the easiest, most common one, the convertibility type. And that goes right into the first part of this chapter where he discusses, specifically he says, don't be seduced by bond features. And, specifically, it's important. The biggest takeaway from this whole chapter that I'm getting is to fully acknowledge that just because you put a bunch of bells and whistles on a bond, it doesn't make it more safe. And one of the primary purposes of investing in bonds in the first place is to have safety, to have a security of principle first and foremost, that you're going to get all the money back that you gave them, essentially. And so, and companies will do this. They add all these features, they add things to their senior securities, hoping that it will attract more people to buy them because it makes the price higher. For their bonds, they can sell them higher. And then it lowers the interest payments that they have to pay out for these bonds, the way that I see it anyway. But anyway, so the different elements of the general items of speculative features are, the extent. He says he divides it into three categories. The, potential gain that you can have. For example, if you have a bond that can only convert into preferred shares, the potential gain is very limited. Unless those preferred shares are also convertible, that kind of a thing. He talks about that later on. Time before profit. So, there are some bonds that, the speculative features don't kick in for a year or two. Like you just sit on it, and so that adds an element of, keeps the price of the bond lower than what it could be if you didn't have that that period where you can't convert it during, for example. And then the duration of the privilege, how long it goes on for. So whether there's a period where you can't use the speculative feature, or how long you have to use the speculative feature, and that's more for sinking funds, that kind of a thing, where the assets are have limited usage, and so that's a feature that's used more for that. Anyway, to focus on the first parts of this is that obviously the best possible feature you can have on a bond is no time constraint at all. You can, like a convertible bond is just straight convertibility. You don't have to wait, and you don't have to do it by a certain date, and there's no, uh, there's nothing making you compelled to change it over sooner than later. And then also, it's also best if there's no potential value limit on it. For example, if it's only convertible to preferred shares, that puts a pretty strong, like straight convertible shares, that puts a pretty strong cap on the limit as to how much you can get out of it. And then one note I put in here, he mentions, I think is important, is that the real advantage of speculative features is, ends up being selling at the right time. And, as a bond investor, we get into that later on about how that all works. I mean, for example, well, it does get into it a little bit here. So the conversion to stock, or the exercise of a subscription, for example, feature of a bond, it changes your investor position. You're no longer a bond investor. If you bought your bond and you switch it over to stock, and you're holding that stock, you're not doing what you initially intended to do. And that's important, especially for market psychology. Like that's something I think all investors really need to be highly aware of, is what, and this goes for any kind of stock that you buy as well, what was your initial intention to buy this? Or are you hoping to gain a swing in the market, that the price, you think the price is just going to go up, and then it goes up and then you don't sell it? Well, you're not doing what you intended to do. Same with, purchasing a convertible bond. If you're not taking advantage of that, and he says in here, typically if you get a 25 to 35% return, it's time to cash out as soon as you get to that point, because past that point, you're putting the value of the bond at risk. You can lose that 25 to 35% very easily. And so, you've already won the bond game if you got that much of a return that easily on a bond. So, he's like, sell that immediately. All right. So, he mentions that participating is better than a convertible. So a participating bond means that, it already is a stock, so it means that if the common shareholders get a dividend, your bond also gets dividends. So it's like, it's free stocks attached basically to the bond if it's participating, and that's a pretty fun feature to have. Convertible puts a little bit more constraint, because you have to time the market with a convertible. With participating, you can hold on to it until these shares are paying out a dividend, and then the value of your bond is just going to go up. It's the value of the bond plus the share price at that point, essentially. So yeah, participating being a very attractive feature, participating bonds. But again, if you want to really participate, why bother with the bond? Why not just own the stock? That's part of it. So one important part about this is that there is a scarcity of participating bonds. I guess they typically are, it's a nice thing to have. So it's harder to it's harder to buy. Sorry, that was a jumbled mess. I do that every once in a while in these videos. Please excuse it. My goal, I'm going to mention right now, my goal with this whole thing is to just get through the book, try to get through as many points as I can. I might redo some of these videos at some point. But anyway, he mentions scarcity of these participating types of bonds is not very liquid, and therefore it's a lower. They sell at a lower price, and so they can. It's not a huge market apparently. Not. I mean, this is in the 1940s. I don't know if it's like that still today. So then we get into subscription types, which oftentimes operate as having a detachable warrant. So when you buy the bond, you basically get a free warrant. If you don't, I'm sure, I hope anyone watching this knows what a warrant is. If you don't, just look it up. Pretty simple thing. So bonds with detachable warrants, he says, do best when the market has favorable conditions because warrants provide the capital leverage compared to straight stock. So compared to convertible bonds, okay, if you have your warrants, your warrants are, they're worth really nothing until the stock price goes above the warrant price, and so there's a little bit of leverage involved in that way. But yeah, there being a time limit aspect as well. It's like, yeah, you gotta weigh it out. If you're looking to either get a convertible or something with warrants on it, obviously with the warrants you need the price of the stock to go up, within a certain time. But then, then you get the leverage. So it's interesting the comparison between those two. Now we talk about callable participating callable participating bonds. So if you have a bond that's callable and participating, that's the company basically saying like, all right, yeah, they are participating, but I mean, obviously what the company is going to do, controlled by the shareholders, is immediately when it's like a penny once there's like 1 penny of dividends, they're going to get called because why would the shareholders want the bondholders to really actually participate for any meaningful amount of time? So that's you want to avoid callable participating. Callable convertibles are better if it has to be callable. Also, callable with a set higher price can help mitigate the negatives of it being callable. And then we have non-detachable warrants. If it is customary, if called the holder to get an equal warrant. All right. So he says warrants beat all bond features for added speculation. And he says the most options are available when the company does very well. Best course typically is to sell the warrant and keep the bond ex warrant without warrant. So if you're the bondholder and that's a thing with a convertible. Once you do the conversion, you don't own the bond anymore. So why'd you buy the bond in the first place? Again, bonds are for safety, and so the warrant aspect of it, he really likes because, it gives you all the upside without the reinvestment risk, of course, once the warrant's gone, you lose the speculative feature. But, this speculative features on bonds really need to be seen as, the icing on the cake, not part of the cake. Like, I think that's a good way of describing it. Also, just to make note right here at this point, well, everything discussed so far when talking about bonds, we're also referring to the same thing if it was happening to preferred shares, because preferred shares also have, the limited coupon rate. So, yeah, and then, but if the continuous income, he says, aspect of owning a bond with added speculation, he says participating is actually best. So, so most speculative is the warrant. It's like, it's like pouring gas on the fire versus participating, non-callable. Remember, non-callable participating is best if you just want that income coming in and coming in and coming in, and sometimes it can get like ridiculous. You just keep getting it in, like, that's a really great bond feature, is the participating. I mean, the point of bonds in the first place is the income, and then you have potential for a lot more income. Like, that's very nice type of investment, very nice form of investment. So, again, this chapter, you can pretty much like figure these things out in your head. Like, he's not revealing anything so groundbreaking. It's sort of just plain and simple logic, like how these kind of speculative features work and their advantages and disadvantages. And the biggest takeaway I get out of this particular chapter is how to think of the speculative features, how to understand them from a market psychology standpoint. Like, why am I buying this? To be really clear about it. I mean, that's what this chapter does very beautifully, very well. All right. And I guess that covers chapter 23 of Security Analysis. Thank you for watching. Please comment anything about the chapter below. Rob's Child.